Good morning and welcome everyone. My name's Paul Hasler and I work in the structured lending team in Durban. I'm going to be your host for this morning's session. Just some housekeeping about today's session. Please use the Q&A chat box on the left-hand side of your screen to submit any questions you would like the panel to answer throughout the webinar. And as per normal, if your screen freezes for any reason, please press the refresh button and you'll be taken back to where you were last in the webinar. Also, you will receive a link with the recording of the webinar, just in case you want to share it or watch it again. And then also we've got other thought leadership insights, recordings of previous webinars, and other information about future webinars on our website. And lastly, we really, really value your input and would like you to please answer a brief survey when this webinar is finished, just to help us improve any future webinars. The big question at the moment is around connection and connectivity. And while we're connecting online in the way we are at the moment, it's important to reflect on the connectivity and the connections in general, but especially when it comes to our money and financial matters. And at Nedbank Private Wealth and Nedbank Financial Planning, we use our globally integrated advice-led approach to connect you to your financial decisions, to your goals and aspirations. And I think the reality we're all finding is that every single financial decision we make affects our ability, firstly, to protect what's important to us, and secondly, to achieve our goals and dreams. Here at Nedbank Private Wealth, we would really like to connect you to technical expertise, a global perspective, and appropriate opportunities with access to services from across Nedbank and other top providers. But I think the most important thing we would like to connect you to is personal and objective advice that you need to make money decisions and to make those money decisions count. And I think this is what we all refer to when we speak about connected wealth. That being said, I'd like to welcome you to our property webinar. The title this morning that we are going to discuss is South African Property Market, Commercial and Residential Markets in a COVID-19 World. And our panel of experts will be looking at discussing the property market and focusing on the current and future trends triggered by COVID-19. But before we get to our panelists, we'd like to give a short presentation by Shala Ramakolo, she's going to provide us with a macro property sector overview. Shala is the listed property equity analyst at Nedbank Private Wealth and manages the Ned Group Investments Private Wealth Property Equity Fund. Welcome, Shala. Thanks.
Thanks, Paul. Good morning, ladies and gentlemen. Like Paul said, I'll just provide a brief overview of the property sector, focusing on the South African market. A year ago, the World Health Organization declared COVID-19 a pandemic. Subsequent to that decision, governments around the world put in restrictions to curb the spread of the disease. One of the sectors of the economy that was worst hit is unfortunately the property sector, especially sectors like the retail sector where trading was limited. Since then, we've seen infections rate drop and lockdown restrictions eased, especially as vaccines have been accelerated in the near past. And with increased vaccine rollout, we've seen an increase in economic activity, which is very necessary for the property sector to function. In this chart, I just show for the retail property sector how vacancies have been considerably impacted by COVID-19. You can see the trend there that in almost all the subsectors of the retail property sector, you've seen huge jumps in vacancy rates. This chart talks to a similar theme. It shows you trading densities. So part of the trading, the collapse in trading densities was due to the lockdown restrictions in March last year. But even after the restrictions have been lifted, you have seen a continued decline in trading densities. As a retailer struggle, and as retail landlords struggle. So not a great picture to see there. And you can see it's across almost all subsectors of the retail sector. This chart speaks to affordability of rentals in the retail sector. You can see the rent to turnover ratio has jumped up. Ideally, you want that ratio to be trending down and not up. So if it's moving up, it's just telling you that rentals are a lot less affordable today than they were. And you can see at the top of the list there is super regional shopping centers. So not a great picture. If we move over to the office sector, you can see similar trend to the retail sector, vacancies moving up. Office vacancies were already high pre the pandemic, and now they've trended even to much higher levels. So not a great picture. Another theme to point out here is the lower quality assets, the C grade office vacancies are the highest there as expected, and unfortunately trending higher. This is my last chart for today. This shows you, on the y-axis, it shows you the percentage of the population that's been vaccinated. You can see Israel and the UK are quite high up there. They've seen the most progress. On the x-axis, it shows you infection rates. So the chart essentially summarizes that as vaccines get rolled out, infection rates drop. And this we need more vaccine rollout to see more economic activity, which will be quite important for the property sector to be on a path to recovery. Thanks, Paul.
Thank you very much, Charlotte. That was quite insightful. We've already, the best part about this is it is an interactive session. Most of the questions we'll be asking are ones that our clients have posed, and they've already got a question for you, Charlotte. And that is, what is the outlook on the listed property sector with regard to distributions?
I think the outlook for 2021 is still not great. The reality is, the focus for most listed players is on repairing balance sheets. And currently the market, we'll hear from the speakers today, but from what we've heard from the various listed counters is they're still struggling to sell assets. So the only other avenue for them to pay down debt is to retain cash and not pay it out, and to instead, retention of dividends instead of paying out dividends is still going to be a theme for 2021, which means, at least for the short to medium term, the outlook for dividends is not great for the listed sector.
This may prove a problem to people who rely on that income going forward.
It is a challenge, but if you're a long-term shareholder, then it's a short-term sacrifice to ensure the sustainability of the business. So it is an inconvenience, but in the long term, if you, like I said, a long-term shareholder, then the business should be in a much better, healthier place.
Once the uptick has happened, hopefully.
Yeah.
Now I'd like to move on to our panelists and some of the questions we've got for them. The overall property market, both commercial, industrial, and residential, has had absolute seismic shocks through the past year as a result of the COVID-19 pandemic. Many of us have been feeling our way through the effects of the pandemic, given that it's new to all of us, and the trends and the other happenings are all new as well. And it's hard to believe that we completed a year of lockdown just recently after expecting a brief 3-week lockdown originally, or at least that's how we thought here. And suddenly we've got working from home, remote technology, Google Meets, Microsoft Teams, homeschooling, masks, sanitizing hands, sanitizing workspaces, sanitizing groceries, all these things. Fist pumps instead of shaking hands, business travel at a limit, even no movies, curfews, and in Durban, where I am, no beach for a lot of the time. And then the trends, the problem that really affected the economy was the alcohol and cigarette bans. And suddenly the world had changed, and how the world perceived the property market had changed as well. So what we're looking to do is to unpack some of the trends that have arisen as a result of the lockdown and the impact that it's had on the property market. The way we'd like to do it is just to do a general consensus initially and then go into more specific trends which the panelists and our experts can talk about. Most of the questions are directly from you, our clients, and we've tried to group the questions. So I may ask more than one question at a time. We've tried to group the questions into themes and thus pose several related questions at once to a panelist. And I would like to now just introduce our panelists to you. Our first panelist is Dr. Andrew Golding. He's the Chief Executive of the Pam Golding Property Group. The group was formed in 1976 by Pam Golding, and now some 45 years later, Pam Golding Property Group offers a full spectrum of property services, boasting a network of over 300 offices in sub-Saharan Africa, as well as offices in the UK, Germany, Mauritius, Seychelles, and they do work worldwide. Our second specialist is Norman Rath. He is the CEO of Brol Auctions. This company was founded in 1975 and is one of Africa's leading commercial property services companies with offices across South Africa, as well as operations in 11 African countries. Services include and are not limited only to auctions and sales, but amongst others, property management, research, and valuations. Our third member of the panel today, many of you will know Rob. He used to work at Nedbank, spent some 19 years with us. Rob Lockhart-Ross is currently the independent non-executive chairman of Fortress REIT, chairman of Trematon Capital Investments, and a board member for Heriot REIT. For many of you, though, you will remember Rob or know Rob as the managing executive of Nedbank Commercial Property Finance. If I can just begin, Andrew, with you, if you don't mind. We've had several questions around the current state of the residential property market, and there's about 4 I would like to group for you just to have a look through. And in this regard, how has the property market fared over the past year? Did the property market react to the pandemic, and how so? And I think one of the main questions here has been around the reaction of prices. And then if you could just cover a general trend relating to the supply and demand that have emerged as a result of the pandemic. Thank you.
Thanks, Paul, and good morning to everyone. I think that in order to get a perspective on this, one's got to go back almost exactly 12 months to a property market, residential property market, that was quite subdued anyway, and that had come off the highs of 2017-18. So volume was down, and prices were also tending down pretty much in every segment of the residential market. There was certainly a sense that a price correction was happening. And then COVID hit. We went into lockdown, obviously, and post-lockdown, there was an expectation that there would be some pent-up demand as a consequence of the deeds office having been closed for at least 2 months. And so the market came out of the starting blocks reasonably strongly in July of last year, and the expectation was that thereafter the market would continue in its subdued form as it had been pre-COVID. I think to everyone's surprise, and predominantly off the back of the low interest rate catalyst, which was effectively a 50-year historic low, it became apparent to us in round about September that there was something happening in the market which was unexpected. And to, I think, everyone's surprise, the market was buoyant. There was a lot of activity, and that activity has effectively continued to today. I think what we've seen is a number of significant structural trends, which I'm sure we'll get into during the course of the morning, but volumes have been up quite significantly. And while prices have certainly not shown any significant house price growth trends in the last 6 months of the calendar year last year, we're now starting to see that market move as sellers become a bit more resilient to opportunistic buyers who were certainly very prevalent in the early days just post-lockdown. So we've seen a residential property market that I think has been fueled predominantly from the bottom end of the market off the back of this low interest rate environment, a situation where in many cases normally renters were looking at the property market and saying, off the back of my remuneration or me and my spouse's remuneration, we can now afford to buy a first-time home in the South African market, and that has fueled, I think, the trend that we've seen at the one end of the market, and which has really pushed the entire market up, and which has resulted in volumes and values in terms of overall values of properties being sold for the last 8 months or so, significantly higher than, for example, the last 8 months of the previous period to March 2020. A number of structural trends have materialized, but as I say, I'm sure we'll get into those in due course. Things like semigration, like the fact that remote working has had a material effect on the residential property market, significant structural trends around the emergence of Zoom towns and the ability that people are now able to live and work where they choose, and a number of other interesting trends around international purchases and second home buyers too.
Thank you, Andrew. So the trend of new people buying their first homes is quite significant, especially obviously we've given the low interest rate environment, but it seems to be a trend that's here to stay, where people are buying their first homes.
Yeah, very much so. Obviously interest rates are not going to stay at this level forever, and so I think there is a sense that one needs to anticipate an increase at some point. But certainly for now, it is without doubt the major catalyst in our market, and has enabled a new tranche of first-time home buyers to enter into the market off the back of a combination of low interest rates and the fact that house price growth has been muted for a number of years. And so from a pricing point of view, it's a good time to buy, and a good time obviously to be able to finance your home in a way that is roughly comparable to what you'd be paying in rental, and therefore makes a lot of sense if one is taking a medium to long-term view of capital growth.
Thank you, Andrew. I'd like to move on to Norman. Norman, sorry, just a similar question to Andrew, but more in the commercial industrial space. Generally, what have been the effects of COVID-19 on the commercial industrial properties in terms of pricing, the supply and demand as well, and then any new trends that have evolved as a result of the past year? Thank you.
Apologies. So, hi, well, sorry about that. Basically, what not dissimilar to what Andrew just mentioned, is that the commercial property market was pre-COVID was already struggling. I mean, there was a decline of about 20% across the board with regards to properties and in the price values. And I think the economy was the reason for that. We had a struggling economy. The tenants were battling to pay their rentals, and then along came the pandemic. It was like a real movie, a real scary movie, and not an American fairy tale where things were just brought to a halt. And unfortunately, for anyone who is involved in property, whether it be a tenant or whether it be the landlord or the financial institutions, we got hurt extremely hard. I mean, the brokers in the industry, there just were no deals. Everything was brought to a halt. So what's happened through this, through COVID, I think all through the different sectors, the offices have been mostly affected because people haven't really gone back to work yet to the offices. All the other industries, I think the industrial sector, the logistics sector has remained okay, but they're also affected with the industries. The retail in neighborhood shopping centers have been a little bit robust in this pandemic and survived the onslaught of no business. But what we found is that across the board, the values have come down. The rentals have been renegotiated, and I think all the landlords have got to a stage where they've had to go back to all the tenants and do some partnership agreement with them and enter into this new negotiation phase where they just either can't survive, businesses can't survive because of this pandemic, and 40-year-old businesses we've seen close doors after being in business for many years. They just simply close doors. They just can't afford to not only pay the rent, pay the salary. So everyone's had to come to the party and try and make a concerted effort to survive during this process. I don't think there's been anyone that hasn't seen or hasn't been part of the damage of the commercial sector. And I think going forward, I mean, we've seen how it's basically distracted the people with regards to paying rentals, and where we are right now is this partnership agreement which we're going into the future, and I think it's going to continue for the next 2 to 3 years. I think there's been a drastic revaluation, and we've been set back 10 years on values of properties and rentals, and I think that's where we are currently at the moment.
So reversionary rentals, it's even worse than that, not just going back to the start, but maybe even lower than the original rent.
So we've seen rentals that were around 2005 in the industrial market. We've seen rentals come down 100 or 50% in the retail space. We've seen rentals in the commercial office space, basically where property used to be of value is a liability at the moment, because not only is it a ghost building, there's just no one wants to even pay a rental, even if it's a low rental. So I think what's happening is that these buildings have to be re-engineered or made for alternative use, and there needs to be creativity, and then these young entrepreneurs entering the property sector, which thankfully, because of the low interest rate, has lowered the barriers to entry, but they're not going to overpay, and we haven't seen any investors wanting to overpay because of what's available on the market. They're spoiled for choice because of the prices that have come down. But saying that, I still think there's the private sector and then there's the listed sector, and I think the listed sector property prices are still overvalued. I think they will still come down over the next 2 to 3 years in time with the adjustment of rentals, affordable rentals for the tenants can pay. But most certainly the values in properties have to come down alongside that.
Okay. Thank you. Rob, if I can come to you and just take you back into your, a few years ago, back into the credit space, where you should be quite comfortable. And the question here is what are the banks, or the overall banks' current appetites at lending, and what has changed since COVID? And the final question is, what are the challenges faced by banks and property owners when considering funding for properties? You're on mute, Rob.
Bear in mind now, Paul, thanks. I'm speaking now as an ex-banker and an outsider of the industry, somewhat looking in rather than kind of looking out.
Absolutely.
But, so it's interesting context for me. But let me start by saying, I don't think you'd be surprised to learn that new commercial mortgage bonds registered to the Deeds Office in 2020 were down nearly 2/3 on what they were in 2019. And so I'm not going to suggest that that's one measure of the level of activity in the market and the level of bank lending, but it's obviously not the only measure, and it's not necessarily indicative in its own right on bank appetite. So I think bank appetite last year, or the level of lending last year, was determined as much by the level of activity in the market and by reprioritization of the banks, of their focus and of their resources. With the advent of COVID at the end of the first quarter last year, banks' primary focus necessarily shifted away from new lending towards protecting the existing book and looking after the existing customers. And as an ex-banker, I do think the banks across the board were commendable in their behavior in terms of accommodating their clients through provision of repayment relief, interest-only periods, extension of terms, covenant waivers, and all of those things, particularly covenant waivers around loan to value as opposed to interest service cover ratio. And Norman used the word partnership early on, and I think this accommodative partnership on behalf of the banks, along, of course, with as Andrew mentioned, the unprecedented 300 basis points drop in the interest rate, I think it meant that the property sector and the banking industry have come through the worst of COVID better than we might have feared perhaps 6 months ago. So I think you will have seen more recently the reporting by all the major banks through to December of their financial results. And I think while all of them reported substantially reduced profitability, you will see they all made comments around their non-performing loans book, and their bad debts experience wasn't as bad as they'd anticipated. Okay. So, what I'm saying there is banks are in a better position to refocus activities back towards the front book, the new lending, than we might have anticipated. Certainly in my own kind of networking experience, I'm not aware of any of the major property finance lending banks have any substantial, severely distressed property portfolios or property loans on their current books. So I think you'll see new lending picking up again as activity in the market resumes. There's another factor at play here too, beyond just the appetite of banks to do new lending. There's the imperative of banks to do new lending. Kind of as an asset-based lending bank, if you turn off the lending tap at the front end, your back book in the form of the existing loans can roll off quite quickly, and that obviously reduces your interest earnings as your operating expenses continue to rise. So that will be at play. And in the commercial property arena, I think that's going to be complicated by the fact that several of the larger REITs are in a process, as Charlotte mentioned, of reshaping their portfolios and de-gearing their balance sheets, which means that REITs, which would always have been a substantial component of any property finance book, likely to be a lesser source of new lending into the future, I think. So, I'm not suggesting here that banks are going to simply, open the lending taps and that banks' appetites haven't changed. The reality is they were changing anyway pre-COVID in response to the economic environment. But I think the banks' appetites are going to be more nuanced perhaps than they were in the past, differentiated by several factors, by the borrower, the property type, the geography, and the tenant covenant. My sense then would be that all the banks will be quite happy, quite prepared to provide finance, even at fairly aggressive levels, on new transactions to existing clients and to established players with track records and portfolios, on almost any transaction across all asset types, except maybe for offices and hospitalities. But at the other end of the scale and differentiate, banks are not going to be as keen to provide finance for standalone assets, for non-clients or new entrants into the market, especially the property in question happens to be a partly tenanted, partly vacant office building with rats and mice tenants in Randburg or the Durban CBD, as opposed to a newish distribution centre on the R21 or Cape Town Industry, etc. That's tenanted by a blue chip logistics operator on a long lease. So I think you'll find that as a nuance. And the other nuance, I think you will find that banks are going to be paying far more attention in assessing new lending to serviceability of the proposed loan and the sustainability of the client's cash flows. In the sense of looking much harder at the strength of the tenants, the length of the leases, and the availability of clients' cash flows outside of the particular property. To want more line of sight on how robust a client's future cash flows are. Being cognizant of the surprising and short-term damage that has been done to clients' cash flows from rental reversions and the lease concessions, and the lease expiries and the non-renewals and all of those things, plus obviously the artificial expenses. So, that's not to say, of course, in focusing on cash flow and short-term and medium-term sustainability, that banks won't also pay attention to traditional measures like loan to value. I just think it'll play a lesser role in this current environment, in part because of the difficulty of pinning down exactly what value means in the current environment. And I'm sure we're going to talk about that a little bit later on.
Yeah, no, we will definitely get to that, and the repurposing of properties, both residential and commercial, a little bit later. Andrew, if I can come back to you, you touched on a term which I think a lot of people probably only heard for the first time last year, and that's semigration. For those of you, I've got a brief definition, but I think Andrew will fill us in a bit more. The concept of semigration has been developed for people who seek a better quality of life away from congestion and the concrete jungle, was one quote I saw. And perhaps, Andrew, you can give us an indication of how this trend has played out, given that people are working from home more and many are semigrating by purchasing or renting second properties and moving to these less congested areas. And I think in line with our discussion around the lower interest rates, has there been an upswing in the buy-to-let market as a result of the semigration and people moving to these other, or what did you call them earlier, Zoom towns, which is such a nice term.
Yeah.
Thanks, Andrew.
Yeah, so I think there have been a number of trends that have materialized since the market sort of reopened up. I think some of those were an acceleration and a speeding up of existing trends, and others have been new trends that have materialized and which are seemingly now part of the world that we live in. Certainly semigration was something that was a trend that was present in the 2017-2018 residential market. That was specifically a trend of certain people moving from the north of the country down to the coast. And I think what we've seen in this COVID environment is a much broader sense of that, where individuals have realized that with this environment there is the capability of being able to work from anywhere potentially, and to make very different lifestyle choices which are not determined by the commute time to the office or even the city in which the office may or may not still exist. So we've seen a dramatic and structural change happening in virtually every part of the country from that perspective, and that has resulted in a number of significant and material changes to towns and areas in the country which were previously designated in a specific way and which have now changed. So examples of those would be the coastal towns like Hermanus, like Knysna, like Plett, St. Francis or Port Alfred. Ballito is another example where essentially off the back of lifestyle choices, people are now saying, well, I'm going to make my permanent home there or my semi-permanent home there and be able to either operate permanently from that as a consequence of Zoom and remote working, or in fact change my way of working, that I only need to be in the office wherever that is 1 or 2 days a week, and as a consequence make different changes. So pre-COVID there was a great deal of emphasis on traffic, commuting times, and the requirements around live, work and play being in close proximity to each other, and that has certainly significantly changed with the advent of COVID. I think other things that have materialized is this notion that certain people have now realized I'm going to be living and working from home, and therefore I need more space, or I need altered space. I need to accommodate the needs of my family, which may be 3 or 4 people needing to have workspaces, but not in the same room. And so as a consequence of that, there are changes happening to the domestic space. And I think we've seen different changes happening in different market segments. So the buy-to-let market, in fact, hasn't really had any kind of boost, because I think the residential rental market, just like the commercial market, has been under significant pressure. So tenants have been able to renegotiate leases downwards with landlords, and so the rental yields and rental investment opportunities have certainly been muted. And in addition to that, I think we've seen, as I said earlier, a significant tranche of what usually would be renters now becoming buyers. And that's also put further pressure on the rental market. I think another trend that we've seen is off the back of what I alluded to earlier around changed living spaces and living requirements, is certainly an acceleration around the green trend and the notion that people are much more green conscious and therefore adapting their homes in a particular way to new energy considerations, and certainly a predominance or an increase in what was already a trend in place. Security still playing a really significant role in people's choices around home buying. And so the residential real estate estates, I think, have benefited from a combination of the lifestyle offering that they were already offering, obviously good security as a factor, and the fact that people are looking to make choices which now include the living and working environment in total. So I think maybe the last trend is just one from a real estate industry perspective, which was in place and which has accelerated, which is as a consequence of COVID, the need transaction process. And I think all of us in the residential real estate industry had to move extremely quickly to have effectively a contactless environment, an environment that was COVID safe, and which needed to automate and digitize a lot of the processes which were manual and face-to-face. And I think we've arrived at a point now where, as the market returns to some kind of normality, we've benefited from that increased digitization, and where the industry can add value through the knowledge and experience of the individual realtors, providing genuine added value through their interpersonal skills and knowledge, and where the transaction is able to take place in a much more automated and efficient way from a digitization perspective. So a number of really significant trends which we've had to adapt to, and which I think have accelerated through the course of the last 8 months.
Yeah, technology keeps us on our toes, and I guess the expectation of clients keeps us on our toes with the technology aspect. Norman, I'd like to bring you in and obviously and we can just keep on the technology as Andrew has brought forward, is the technology in sales. So the questions that we've got are, what do the sales platforms resemble now after 12 months of COVID? And not necessarily that it started only because of COVID, but it's obviously been enhanced, as Andrew has alluded to. And then have online auction sales expanded and the role of technology therein? And is this trend finding proper traction in the marketplace with clients, the trust issues, those sort of, feeling issues as opposed to touching a building issues? If you can give us some feedback on that, please.
Yeah, so, well, the auction industry, I think, and the digital online platforms have been around for a while. They didn't happen over the last year. I think the platforms have been there and they've been used, and they've been actually quite successful globally. And they're starting to enter into South Africa, and we were using those platforms. I think what happened is that COVID just made sure that everyone, if you didn't have an online platform or some sort of digital platform, that you were going to be falling behind, and everyone went out and built their online sales platform. So yes, I mean, we've entered an era of digitalization. We've entered an era where everything needs to be a convenience for the consumer and for the buyer and also for the sellers. And I think this platform, it's been very beneficial that it's been expedited through, unfortunately, this pandemic. But what's happened is that we've all learned how to use it, learned how to educate our buyer, the buyer market, and now they are basically trading on that platform. But I think we're a long way to go. I don't think our country is ready for it independently on its own, and I think there needs to be still the human element with the digital platform, online platform, and a hybrid of between the brokers and the buyers and the sellers, and letting them understand how to actually use this platform, because the auction industry draws a line in the sand, and we needed something like this. So I think over time it will get the more traction, and people will use it more, and the sellers will use it more. But right now, I think we're not such a sophisticated market where we can just rely on the online digital platform. I think it's got to be supported by a world-class marketing campaign, because I don't think everyone is quite there yet. And I think it will progressively improve, and the brokers it'll benefit them and the sellers and the buyers. And I think in time we'll soon become a stock exchange of property, but there's a very, very important part. The human element exists when it comes to property. You need to walk through your buyers and sellers through this process, and that's what we're trying to do.
Thank you. Thank you, Norman. I think it's always about the touch and feel. The guys like to walk through the building, have a look, and size it up from that side. Rob, back to you. We've had lots of questions around the interest rates and their effect on the property market, and whether or not the low interest rate can sustain the property market, given the vacancy factors, especially in places like retail and the office space. And is there, the final question is there any correlation between the prices of properties and the low interest rates that we're currently experiencing? Thanks.
Thanks, Paul. Look, I suppose it depends what you mean by sustain. As I said earlier, the historically low interest rate has definitely shielded the property market, in the sense that it's made serviceability of existing loans and affordability of new loans much easier for the investor and the buyer. And that's compensated to a greater or less extent to the reduction or compromising of one's net rental income. For a property investor and the landlord who's faced with, rental concessions, spiraling vacancies, rental reversions, abnormal expenses, escalating holding costs, the commercial property market could have been in dire straits had the Reserve Bank not made the unprecedented step of a 300 points reduction in interest rates, which was very unlike previous financial crises where we had a hike in interest rates, which would have been catastrophic. But, I don't think that in and of itself, the current low interest rate can sustain the property market indefinitely. And not only because of the point that Andrew made that in the longer term interest rates will rise again towards a longer term mean, although I don't think there's any expectation that rates will rise significantly in the short to medium term. It's only the resumption of robust economic growth that's going to sustain the property industry and get it back to the level that it used to be at. We need that growth for all these concessions to be uplifted, the catch up of the backlogs to be caught up, for rentals to be serviced, vacancies to be filled, space to be taken up, and escalations to resume. And then you'll see valuations restored and liquidity returning to the market. So for now, I think all the lower interest rates have done is given the commercial property market a very necessary respite in the storm and time to breathe and time to make some sort of assessment around what are the longer term implications of the current stresses, what are the longer term implications on the core problems and embedded flaws that have existed in the market, to try and make some sense of the apparent trends. And I say apparent because some may be real trends and some may not be. And then to kind of look at some of these emerging solutions. And I'm sure we're going to talk about all of that again later on as well.
Yeah, absolutely.
You asked whether there's a correlation between prices of property and short-term interest rates, and of course there is, in the same way that there's a correlation between longer-term interest rates and valuation of properties, as typically the longer-term rate is used as the basis for the cap rate and the derivation of value. So, look, I'm not a valuer, I'm an accountant by training. But as an ex-banker, I can assure you, I must have read and scrutinized thousands of commercial property valuations in my time, and without any meaning disrespect to valuers, the concept of value can be esoteric, and the determination of value can be quite subjective, even in a stable economic environment where there's relative certainty around all of the inputs that necessarily go into a valuation. So you can imagine how difficult valuation of a property can be in the current environment, the postcode, with the degree of uncertainty around all of the inputs. So it's not been surprising, actually. A lot of the commercial property valuations that were issued and still issued during the heart of COVID and at the moment have been qualified by the valuers because of the existence of, quote, material valuation uncertainty, which really stems from question marks over whether historic data on which valuers have always relied is necessarily applicable to the future, and difficulty in assessing, what kind of interest rate one should use as the basis and what sort of risk premium one should put on any kind of transaction. So forgive me, I'm a layman here and I'm speaking more as a banker, but seriously then as an analyst, or an auctioneer or an accountant. But my own personal view is in times like these, one can and maybe even should distinguish between the valuation of the property and the pricing of a transaction. And I'm not sure they're necessarily the same in the current market. Valuation would be defined by any professional valuation body as being the price at which a transaction can be concluded. An asset will change hands between a willing and informed buyer and a willing and informed seller at arm's length and in a perfect world sort of thing. And we far from that. So I think what happens is in the shorter term, the lower interest rate obviously improves affordability of existing loans and improves access to finance on the part of the buyer, and that will affect the pricing of a transaction. Similarly to the lack of liquidity in the market in the sense of the number of buyers and the number of sellers willing to play in the market can also affect the pricing of a transaction, as again is the presence or absence of distressed sellers in the market and opportunistic buyers can affect pricing. Yeah. The bigger difficulty is trying to determine value. So, Norman's job is to sell a property. So for him, value is going to approximate pricing. Accountants, and I'm one, want to mark everything to market at a point in time. They're going to be focused more on the sort of pricing perspective. Valuers necessarily have to take a longer term through the cycle view of valuation because, they're trying to extrapolate future cash flows, etc. And my own sense is we as bankers also tend to trend towards the longer term view of value rather than point in time value. And the reason mainly for that is in looking at a loan as a banker, I always look at two things, or the rating of loans determined by two things. Firstly, probability of default, which means what is the likelihood of the borrower stopping the servicing of the loan and it going into default. That's the first factor. And the second factor would be the loss given default. What happens in the event that the client stops servicing the loan and the bank has to call it and realize the security? Okay, so as I said, the first factor goes to serviceability and the second factor goes to recoverability. Obviously, in an environment now where the loan continues to be serviced by the client out of current and ongoing cash flows, the second factor, the loss given default, the recovery, never really comes into play. And that really harks back to why it is that I said earlier on that I think the banks have been focusing on the existing book and on the new lending more on the serviceability and less on the recoverability as measured by traditional measures like LTV, given the difficulty of pinning down exactly what is valuation in the current market until some of this uncertainty sort of clears up.
Thank you. Yeah, thanks. That's quite insightful in terms of just looking at cash flows as well. We've got about 10 minutes left, and I'd like to move on to some opportunities that people have been asking about. So, Andrew, if I can come to you, the question is, where are the pockets of opportunity within the residential property sector? And I think where the one question was does the old saying of location, location, location still hold true, or can people carve out a new location? And many people have asked after areas like Bryanston, Ballito, the Natal Midlands, Nottingham Road area, Val de Vie, etc. And I think it's really just what does the next year look like for the residential property sector? I'd like to say post-COVID, but that timeline is a little bit uncertain. Thanks, Andrew.
So I think that in broad terms, the fundamentals of the residential property market, have always been there and always will be, as far as I'm concerned. So the question around location, I think, still applies. But I think one needs to overlay that with a sense of some of the current trends that I spoke about earlier, make an assessment as to whether they are temporary or, in fact, structural. I think, for example, one of the things I didn't mention was the fact that second homes sales have certainly accelerated, I think, off the back of the remote working environment, as I said. But also, interestingly, we're starting to see international purchasers who can't get to the country, but still, in fact, transacting, because for them too, the lifestyle considerations are the same. So if they are currently living in a relatively small apartment in London or New York or Barcelona, they are familiar with South Africa, then a lifestyle consideration around working from, say, Cape Town or from Plettenberg Bay becomes a real consideration. And I think what we've seen is that in the second home market, people are perhaps deciding not to sell their primary homes, but making an acquisition of a second home with a view to spending a lot more time in those locations. And that certainly is something that is driving the market. I think the other important consideration is around pricing. As I mentioned earlier, I think there was already a repricing underway pre-COVID. I think immediately post-lockdown, we also saw opportunistic buyers looking to capitalize on some seller distress on the one hand, and also a seller appetite to acknowledge that the markets were different and had changed. And so I think that's also fueled transaction volumes. I think what we're now seeing is that those sellers are recognizing that the balance between buyers and sellers is perhaps a little more equal. And for the first time, we're starting to see house price growth become a real proposition, and as a consequence, pricing changes. We're seeing it at every level of the market, from the very top end of the market, and that's in the area of around 70 to 100 million, all the way down to the base of the market, which in our view is around 1 to 1.5 million rand, where a correctly priced property in the current market is selling within days. And so there's a significant buyer appetite at that level. And in terms of supply and demand, that's always going to be a fluctuating factor, which is going to, I think, materialize over the course of the short term, i.e. the balance of this year, where our expectation is that all of these factors that are currently present are going to continue to be present. We're in a low interest rate environment, which I think is going to continue to drive volumes in the market, but perhaps where there is a slight increase in house price growth off the back of what has been at best flat house price growth for at least the last 3 or 4 or maybe even 5 years. So I think in terms of hotspots, one does need to assess whether there's been a structural change in the market or whether these trends are temporary, and then look to do one's homework around a range of factors which determine the buying needs and result. And so I think it's difficult to try and pick individual hotspots around the country, except to say that the trends that are there, I think, are driving those hotspots. I think another consideration is whether the urban regeneration trend, which is a global phenomenon, is going to continue to drive metro markets, and in particular inner city markets, towards what is currently looking like a kind of a micro apartment trend. So in some cases, as little as 15 square meters for an apartment, a one-person apartment, is certainly something that is a global phenomenon, which appears to be an opportunity within South Africa, potentially an opportunity around the repurposing of office and commercial space into residential space. And I think underpinning all of that is a fortunate situation in South Africa, where if the economy can get going and we get real economic growth, then we have a tremendous demand for undersupply in respect of overall housing within the population, and the opportunity that the first-time home buying population can significantly enter the market and fundamentally change the residential property market. So not any specific hotspots per se relative to Ballito and Bryanston, because I think one's got to do one's homework very carefully around the very hyper-local circumstances which are driving those markets, and then make a decision as to whether they are an opportunity for investment or not.
Thank you. Thank you very, very much, Andrew. If I can come back to you, Rob, just to, we've got about 8 minutes, so just a 2 minutes answer is, are the changes in the industry, in the commercial industrial industry, already happening? And the question is what adaptations are needed? I think particularly in retail and office, we've covered a bit of that, given the trends of shared office space, work from home, the regional shopping malls versus local community shopping centers, and then the trend of the online sales, where we've had a huge demand for DCs or distribution centers to cope with the massive spike in online sales? If you can just give us a few of your comments on that, please.
Yeah, look, thanks, Paul. Look, we've spoken about a bit already, and I'm sure Norman will have lots to add on this front. But I mean, and we've said before, and lots of people have written that, COVID didn't create some of these factors. It simply accelerated some of the challenges that have been already facing the commercial property industry that were already evident or imminent in the commercial property sector. Even prior to COVID and the current economic stress we're in, there was significant oversupply in various sectors of the market, particularly office and big retail, let me put it that way. There were significant threats to property owners, particularly conventional business models from market disruptors, from the online sales, from the Airbnb, shared workspace, all of that sort of stuff. And then there were obviously fairly aggressive gearing practices and perhaps some aggressive accounting approaches in the industry as well. So I think even prior to COVID happening, some of this change was already either actually happening in the industry or being planned or being foreseen, either to a greater or lesser extent, particularly in those affected sectors that you mentioned, office and retail, which are now sadly proving to be the sectors that are hardest hit by COVID, along with hospitality. What COVID's shown is the need to change is deeper and more fundamental, and the timeframes are perhaps shorter and more urgent than were required. So the question is further quicker change required across the sector, particularly in those segments? I think the answer to that is yes. Exactly what that change might be and what it might look like is probably a bit too early to tell. Andrew made the point, are these some of these temporary phenomena, are these permanent structural changes? And I don't think we've got to the point yet where we can make the call on that. Everyone talks about a new normal. This is where we're at, is not the new normal. I mean, God forbid this is a new normal, that I spend the rest of my life talking on Zoom as opposed to going back in the office and integrating with people. My own personal view, I think people will go back to shopping malls. People will go back to offices in the same numbers and the same patterns as the past. I don't know, for the same reasons. I don't really know. I just remember post 9/11, none of us flew for a couple of years. Now we get on planes happily again, or did, until COVID hits again. So, that's the nature of the beast here. I don't hold the pessimistic view that some commentators do, of the sort of that Will Smith movie, of swathed of Sandton offices, empty and abandoned, empty and echoing halls and regional malls. I really don't see that. But, all of that's going to take some sort of time to play out. So is it going to mean there are going to be some casualties, and will it mean that there's surplus space, and will it need to be repurposed? Absolutely yes. So will there be more offices converted to residential or maybe healthcare? That's a possibility. Will there be regional malls that will have to introduce like community services, like having the civic offices in there, or maybe educational, more entertainment, or maybe storage or depots, all that sort of stuff? Yes, all of that will have to happen. Will there be more logistics, big boxes and smaller depots for last mile? I'm sure all of that will happen. None of that's as easy as it may sound. Not every office building can readily be converted into residential. There's zoning issues, there's design and structural issues, and there's simple financial feasibility issues around all of that. So none of it is that easy, and it's going to take time to play out. So my last comment around all of that is, I'm confident in two respects. I think the Norman mentioned this, sorry, just as an aside, the new players into the market are also having an impact, kind of particularly like to look in the industrial space now, the WeWork model moving into the small industrial space, which is a new innovation. I think that's going to play out. But I'll go back. The point is the SA commercial property industry as a whole, I think, has proven itself to be resilient over many years in overcoming crises and facing challenges. And I think, and I'm confident that we have, we have the infrastructure and we have the innovators who will be capable of getting through all of this. It's going to take time. And that just brings me back to my last point is just bear this. Commercial property has always been an asset class and will remain an asset class that is best suited to patient capital. No? If you've got a well-located, well-designed, well-constructed, and properly managed property in the hands of a seasoned owner who's got the balance sheet and, more importantly now, the cash flow to weather the bad times and see through the storm, I think it'll always remain an attractive investment measured over the longer term.
Thank you very much for your input there, Rob. Yeah, it's, as you say, patience is a key. And just finally, Norman, if I can just get your, going forward, what do you think the recovery looks like? Just a quick 2 minutes. We're running out of time at the moment.
So, I'm basically reality follows perception, and I think the sentiment right now is better than it was a year ago. There's definitely been an uptick, and I think there's a little bit more confidence. We've seen it. I can only tell you what we've seen on the ground at the cold face of the trading of commercial properties, and that's, I think, why I'm here. And we've seen basically investors, new entrants, new property developers or entrants or getting into the space where they're going to convert commercial or offices to residential. We've seen a massive increase in that. I think the way forward, what we're going to see over the next couple of years is positive. Like you said, like John said, I think property is the ultimate legacy. And I think what's going to happen is that people now with the low interest rates are going to look and seek the opportunities. And I think the sellers are starting to become a lot more realistic. We've seen the trend over the last period is that a lot more deals have been done, albeit at a lower value. The sellers have taken less. There are many buyers at a certain price, and it's across the board. Even offices have been sold at the right price. I mean, some people don't want to get into the commercial space because it's very difficult, and they're not wrong. But there's a buyer for an opportunity, and if it's correctly priced. And I think that's where we need to get. There's a big disparity between buyers and sellers. But I think overall, the logistics side, there's been massive demand. Every property that we've got in the industrial side has been sold. And again, there's been some tight yields that has been going on in the market at the higher level for long-term leases. The sustainable cash flow is chased by the investor. And I think that's what's happening. Neighborhood shopping centers, they don't sit on the shelves for long. They get snapped up. I think that's the trend. I think as long as South Africa, where the demand for housing for these residential blocks exceeds the supply, there'll be these investors in the residential blocks, and they'll be continuing to have a robust in this environment asset. And I think that's the way we're going to be going forward. I think there's a lot of good things to look forward to. We've been reset the pricing, I think, to maybe 10 years or maybe even further back for certain properties. And I think it's allowed people to relook at their investments, and maybe it just got away with us historically. But we're very bullish about it because we are selling, we are trading, and the numbers are above 50% at our auctions, and we can see it. And there's a new hub and a new buzz in the environment. But things are coming to the market that historically were never on the market, and there is pressure out there, and it is difficult. And those investors that now need to sell certain assets that were never for sale before are reaching new buyers and new investors, and it's very, very attractive for people to get involved. So I think long term and over the next year, in certain segments in Durban and Cape Town, the logistics side, and near the R21 here in Johannesburg, there's still huge demand for those properties, and I think they're going to be snapped up. And we're looking forward to trading on this platform, and we're looking forward to what lies ahead. It's not going to be easy. But I think if everyone comes a little bit towards each other, where the sellers come down a little bit and the buyers are there, we'll do a lot more deals going forward, and that's the space that we play in.
I think it's to Andrew's point, and actually to almost all of you have mentioned it somewhere through this webinar, is the right price. And if the properties are priced correctly, then, and as you said, bring the buyer and seller together. And then the other one, obviously, is the repurposing, where somebody can see an opportunity in a property and utilize that opportunity to repurpose, re-engineer the property into something that is cash flow positive. We seem to have run out of time rather rapidly, and I was warned about this before we started. Thank you, Cleo. We were going to take some questions, but what we will do is we will respond to your questions, the ones we haven't answered on this webinar. We will respond to those questions in the next week or so. Me and my team and our panelists in need will get back to you guys, to our clients, and we will be able to respond to a lot of those questions. We have other, particularly around Section 25 of the Constitution, we have other webinars which we will be able to address that at. And just in conclusion, we are hosting a smaller, more interactive session, and it's particularly on Nedbank Private Wealth's unique approach to financing commercial industrial property. The session will focus on what financial institutions require if you apply for a bond when purchasing the property. And this goes into, as a lot of our panelists have mentioned, loan to value, cash flows, the background assets, all that sort of information that's now required. When in the older days it was a lot more simple, it's a lot more detailed now, and we would love to help you with that. And you can leave your details in the left-hand side on the chat box. Just post your name and surname and bonds, and then we will come back to you. The only people that can see your details are the webinar administrators, so not everybody can see that you're that you put your name down. There's no problem there at all. And just in closing, I would really, really like to thank our panelists and Charla. So if I can, Charla, thank you so much for your contribution. And then our panelists, Dr. Andrew Golding, Norman Rott, Rob Lockhart-Ross, for their outstanding contribution in making this webinar a success. And hopefully everybody's got something out of it. If you require further information, you're more than welcome to contact us, and we will provide whatever information you're looking for. And so finally, to you, our clients, thank you so much for joining us this morning. Goodbye.